Okay, cool. Hi, everyone. My name is Allison Murdoch. I am the founder and chief marketer at a company called Trusted CMO. I work with early stage and growth stage companies to get marketing done right, which is quite a challenge. But it's my pleasure today to moderate this panel about preparing your company for an exit. So some of you are like, I just started, why am I thinking about that? But I think we all agree that you should think about it. So that's what we're going to talk about today. And with that, I'm going to turn it over to Andreas first to make a quick introduction, and then to Claire.
Sure. Thank you. I'm Andreas. I'm the founder of madewithlove. We do, I guess, similar things, but on other fields. We mainly work with tech startups that are struggling with the technical side of things. So we help CTOs and management teams scaling up their technical teams.
Good morning, I'm Claire. I'm partner at Ventech, which is a pan-European VC firm investing in early-stage tech companies. We have offices in Paris, Berlin, Munich, Helsinki, and Stockholm. And we are investing tickets from 1 to 5 million euro, working with the founders and entrepreneurs as an active investor, being at the board, to grow their company globally. We've been in this business since 1998. We started in 1998. We're celebrating kind of our 25-year anniversary. And so have invested in 220 companies, have exited a little bit less than 195 companies. Exits meaning different scenario, loss, trade sale, we'll discuss about that, IPOs. The big announcement this year was the sale to equity of Believe in the music space for 1.5 billion. So they are big successes, which I wish all of you to find one day.
Great. Well, so we're going to structure this panel a bit like from beginning to end. Like, what should you think about as you're just, what's possible to imagine what your exit might look like. So the first question I have, and I think I'll just start with you. Well, you've got the mic. Claire, there you go. Since you've got a history in exits, what do exits look like today? What are some of the options that as a founder you should learn about?
Yes, so originally you had two types of scenario for exits. One being the strategic sale, so a trade sale. You sell to an industrial in your sector, a competitor or whatever, and so it's an M&A. It's a merger and acquisition. Second one, for the biggest one, I think we'll go on that, is the listing on a public market, so IPO. Nasdaq is in the US is a very active market. Euronext in France, in Europe, is a little bit slower, largely behind Nasdaq. Being a European founder, you can look at both markets. So we had in the past, maybe for the French one, Criteo, who was listed on the Nasdaq a long time ago, Business Objects, software company over there. For us at Believe, as an investor, we wanted to promote the European industry, so we listed the company on Euronext. We'll elaborate on that. We learned lessons on this listing. So they were initially the two main exit scenario. And 4 years, with the development of growth fund, of PE funds, which were already in the US, but less funds in Europe, we now have PE, private equity funds, that are looking at quite mature company and investing in this company, most of the time taking a majority, so it can be for funders and investors, partial or total exit. So investing in the company with a view to do some build-up. So large funds, you can think about Marlin Equity, PSG, but also in Europe, EQT, Swedish, several large funds that are able to invest in your company, always majority owner, and then in financing build-up to grow the company. So they're the three types of exit I'm thinking of. and that are available.
Yeah, I'd love to get your.
Yeah, there's one type I would want to add, and that's there is groups of companies or companies buying actually not the winners, but like the mediocre startups. I think there was one company present here as well, SaaS Group, who's doing that. So they're pulling together like smaller SaaS businesses. So I think it's also as a SaaS founder, if you're kind of burned out on your own business, it's a good way of exit as well. It's other than private equity, of course, because in private equity you're supposed to stay. And in these cases, they really take over the whole business, and it's a very fluid transition, I guess. And I think in Italy there's another one. It's called Bended Spoons. So there is SaaS Group, Bended Spoons, and in the US you have, for example, MetaLab, who's doing the same. They own Dribble, for example. So I think that's also something that if you have a SaaS business and it's not like becoming a unicorn and IPO is not an option, private equity, you need to have very good numbers for that as well to get something out of it. So then selling to these kind of groups is also an option, of course. Yeah. I don't know those, but I guess there's like Visma, for example, the Norwegian company doing the same. Yeah, it's like conglomerates buying lots of different companies. Yeah, it really depends if they try to pull it together. What the companies I'm talking about, what they do is they really try to make the synergies between the companies. And for example, they'll organize everything finance and accounting centralized. So the company only focus on products and engineering, but all their services are centralized. I guess in those groups they try to do that as well. Yeah.
It's kind of like a subsidiary model. Like Omnicon did this in the publishing world, where they picked up PR firms, or picked up different media companies because the margins are so bad in those. So we have lots of options. That's the good news. But I think it's important to get into now thinking about what it takes to have a successful exit. And part of that is the first part of your job, which is to get funding if you so choose, and what some of the pitfalls are and things you should watch out for when you are considering funding. So Claire, you have a lot of experience with this, so we'll start there.
Yes, sure. So first statement, not all companies need to raise external funding, equity financing. So you can be self-financed, you can be financed by bank financing, and then in that case, there is no exit scenario to consider. You just reimburse the debt or whatsoever. For those, and this is mostly the tech startups that want to accelerate growth, accelerate product development or whatsoever, they raise equity financing from investors. And when you start this process, because that's the mandate we have ourselves from our own investors, is that that at some point there will be an exit. We spoke about the different models. So one thing that you have to think about is with whom you team up. First, your own agenda. You as a founder, as an entrepreneur, what do you want to do? Do you want to build the company for your children? Where in this case, you need to look at the specific financing solution. Otherwise, let's forget this example, or the example between startups and VC. Then you need to understand with whom you team up in that sense. How much, what do you want to build with your company? How much financing do you need? How long do you see yourself? And sometimes it's difficult at the beginning. You don't really know when you should consider the exit strategy, but at least speak with your VC to understand what's their maturity, what type of maturity, what type of investment maturity they have. And the first, when we discussed that with Alison, really you need to align the different stakeholders, being the company, the founders, the management team, and the investors. One pitfall is when first in the VC investors, you have different expectation in terms of valuation, as well as different expectation in terms of how long you want to stay in the company. Very easy to understand. Some funds invest in your company at the end of their investment period. Some will be at the beginning. Some have, we call that evergreen. They don't have any maturity in their fund, so the time, they will need to exit at some point, but the period they hold their investment is not important for them. So you have different types of VCs. So that's for the period. And the expectation. We've seen in the past exits that were totally destroyed by the fact that some of the investors wanted to exit at 100 and the other one at 1 billion. I mean, in this range. So obviously the expectations are not the same. So when you raise financing, that's why from day one to exit, obviously when you're day one, you're not thinking about the exits right away. But still, you need to understand, do I raise 5, 10 million? Am I in a business where I need to raise 100 million? Because the expectation in terms of exit, that sets the expectation for exit in a different way. And also recently, and that was a little bit something that we went through in 2000, so a long time ago when I started, that totally disappeared, but then which reappeared in 2020, 2021, is the structured financing. So this word of liquidation preference, the way your equity is structured. So the investor, they're putting their money, but they want to exit first. So that's okay. But then now, recently, we saw, so they can pay 1 billion valuation. They don't really care. The valuation at which they value when they make their investment doesn't mean anything to you. It's more the fact that they're going to ask, I don't know, 2 times, 3 times their equity first before you start to make €1. It had disappeared in the past, clearly, and then it's starting again, or minimum IRR, minimum return on the equity, minimum multiple, and that creates a disalignment of interest, because there will be some situation where between, I don't know, 30, 50 million euro, they're making some money, you don't. Then after that, they don't make any money, so they don't really care what exit price it is. So really the financing, I'm the financial investor, so I give you my point of view in terms of what you need to think about, but really the financing, the structuring, the exit valuation is all of that can jeopardize an exit.
Yeah, I'd love to get your non-VC.
Yeah, I'm also a bit into VC. I work a lot with VCs, of course, and I'm an investor myself in some funds. Mm-hmm. I think to get very practical there, as a founder, when you're talking with a VC, go and look at their investor deck. So the deck that they send to their the people that invest in the fund, because then it becomes very clear what kind of returns they're expecting. They're not necessarily, I don't know how you guys do that. It's not always public, but there's ways to get access to it. That really learns you how a fund works. And I think very few founders I talk with actually know that a fund, or most VC funds, are closed-ended. So that means they start investing in a certain year, and typically 10 to 12 years later, they want to be able to sell everything that they invested in that one fund. So that means there is like an expiration date on the investment. You were describing that as well. And it's very important to realize indeed when a fund steps in that that's the case, and that they need to sell at one point in time. And of course, if you can go with an evergreen fund, it's a lot nicer. But also it might be that they will be pushing you less. So it's not always a bad thing that there is these kind of dates, but you just have to be very cautious about the fact that it's there. And you started saying that you could go for bank financing as well, where you say there is no real exit necessary. I agree, but I think for yourself as a founder, it's important to think about where do I want to go with this business. Unless, of course, you want to have fun and not grow too much and be in the business for a very long time. But even if you are bootstrapping, doing it yourself, maybe with some funds from the bank, I think it makes sense to have some kind of a plan and think about the strategic options there as well. And maybe already talk with advisors, not from the VC world, but financial advisors that can help you with what the different options are, and that can help you prepare for that as well, which is a role that typically VC would take when they invest. So if you're not working with VC, make sure you have the right advisors to help you on.
Yeah, I would agree. Yeah. I think you need some different perspectives, and that kind of brings us to the next topic, which is the strategy around your exit. So we talked earlier when we met a little bit about corporate VC. We've talked about partnerships with industry. What are some of the things that you should be looking at as a founder? And I would say the best English word is courting, wooing, like dating. Various, whether it's strategic investors, corporate VC, or other technology partnerships. So ways to get maybe confirmation on the direction you're pursuing and how you're building your product. So I'd love to kind of maybe start with you, Andreas, to talk a little bit from a technology side. standpoint, what are some of the options you should be considering and choices you make as you're building your product?
Yeah, there's of course a couple of types of, if you're talking about acquisitions, as we're talking about, there is a couple of different types of acquisitions. I think the one very wise thing to do is talk with your competitors at all times, have a connection with them, have a conversation with them, because they are probably your best acquirers. And so it depends a bit on the type of business that you're building. So some businesses are basically a specific feature that adds on to an existing product. So for example, if you're building something blah, blah, blah for Salesforce, then of course Salesforce might be a good party to acquire you, or a Salesforce competitor, or other company dealing a lot with Salesforce. So that's like you're building a specific feature, and that positions you in the market already to be acquired because you're an add-on to something else. Another thing is like if you're developing certain technology that's useful, and then acquisition is not necessarily an acquisition based on your revenue, but more on like intellectual property. That's something that you see in the AI worlds. Like the acquisitions that are being made, the valuation is crazy. It's not because they are making good numbers. Like in Belgium, we had a company, they were making 1.5 million ARR, and they got acquired for 160 million. They only existed for 2 years. And so, yeah, these kind of things are happening, and they're happening now. They were happening 10 years ago as well, because it's a strategic acquisition for the acquirer.
Yeah.
And they actually, how that went is interesting to know. They were talking with the company that acquired them for a strategic investment. And so then that turned into an acquisition. So again, they were talking with potential partners to work with, and that led to the exit as well. And so that's one thing. I think also funds can really help, because they have the connections with either portfolio companies or bigger corporates that they work with, or that are searching for more innovative solutions. And then, of course, there's lots of corporate innovation happening as well.
Yes.
Where they're making corporate ventures and corporate funds as well. So, for example, we had a customer that was in the tire industry, like they were making software to optimize the use of tires in mining equipment. And then, for example, they got that investment and in the end acquired by Goodyear tires. So yeah, I guess that's a prime example of that. I don't know if you want to add something to that.
No, I'm very much in line. So we have this say in venture, you're not for sale, you are being acquired. Oh, yeah. So what it means?
Your companies are sold, not bought, are bought, not sold.
Are being acquired. Yes. No, but the process is we are not here saying, okay, my company is for sale, who wants to buy it? It happens, I think, more in the PE world, LBO, more financially structured market, where you show this level of EBITDA, you multiply the EBITDA, you put some debt. Anyway, it's very well structured. Here for us, it's more about you're part of your company is in an ecosystem. So we are in the tech industry. So change of technology, the world is changing at its own path. They are incumbent. They are, as you said, competitors. They are also partners. And that's the relationship. First, an acquisition happens because there is a business interest, not only because you're for sale. So, yes, same as you, Andreas, I had this example of in a B2B ad tech company in our portfolio a few years ago, Sticky Ads. Okay, they were in Europe. The plan was to go to the US. So they build this partnership with Comcast. So that Comcast was their partner to go to the US. After 1 year, Comcast decided to acquire the company. That's what I mean by the company was not for sale. I mean, the company had this plan to go to the US. The US market was a target for them. They used Comcast as a partner, and then rapidly, Comcast didn't have the product, and that was about the product. Didn't have the product in their roadmap. It was the market they wanted to target. Say, okay, we're going to acquire.
Yeah, I think a lot of this is timing and being open to opportunities. Just from an entrepreneur and somebody who works with a lot of startups, the mistakes I see people make are, no, we're talking to them right now. I'm like, you should be talking to these others. You should be talking to your competitors. Your VCs are like, they're your advisors, they're your helpers, but they're not your friend. They need to make a return. And so you do need to have these conversations with other people. Like if you're saying, hey, I hope HubSpot buys us, we should be talking to Salesforce as well. Like this is just the game. And I think that I've seen founders get really excited about a potential conversation, and then it just ends. They get ghosted, and then they're starting again. So that's, the reality. Nothing against VCs because we love the money, but but they have to make a return. So imagine you've got these conversations going, you have some potential exits, you've thought about it from your team. I think one of the things that where I see exits fall apart is two things. Is one, the strategic alignment among stakeholders, which could include people on the management team, it also could include your investors. I'd love to talk a little bit about how to gain alignment and also the timing of that, because it might be earlier than you think. You know, what is the best way to get everyone on the same page so that if an offer comes through, you can act quickly?
Yes. That's what I mean by being connected to the ecosystem. It never comes out of the blue. I mean, so yes, you are in discussion. Suddenly, you receive some interest from an external partner, and then you start to think. You never know until the end whether the exit will happen. So you start. You have the choice to get some advisor to organize a process, decide to do that by yourself, understand, and that's, as a VC, I know that I feel that it's my role to always talk to a lot of advisors, M&A banks, to understand, to how mature is the market, because again, you're not a bakery, it's about technology with cycles, with consolidation timing, with timing where the consolidation is over. So you need to understand these the timing. If you miss the exit window, maybe it will be another cycle. Or what do you need? And that's where it comes to metrics. What do you need to reach this type of valuation? What type of financing do you need to reach the next step of valuation? Yeah. And that's something. I don't know if you want to get that now, but in terms of financial things, they are clearly, the world has changed. I mean, 2 or 3 years ago, you could sell a company that was totally loss-making, dreaming about...
still in beta.
Yes, still in beta, saying, yes, but one day I'll be profitable and one day I'll reach 100 million euro ARR. That doesn't happen anymore. I think, IPO, even
it's cheaper to build companies now, too, than it used to be. You don't have to wait you can build... I'm sorry to interrupt. I did have a really interesting interview with a company. I think it's UserFlow. Do you all know UserFlow? Okay, Scandinavian. Okay, so 3 founders. Everything they did was in the cloud. So during due diligence, he said, which we're going to talk about next, and I'm preparing. He said, where is your data room? He said, well, here's the login. Just log into the product, log into all of these things. 3 founders, I think they exited, they were acquired by another company who was looking at them to add to their roadmap, 45 million, 3 founders, no VCs. That's a really good exit. So point is, it is a different world in terms of building a company. You can, but you also need to be ready for that timing, because the timing can happen at any time. So one of the things I would like to dig into, and I'm also mindful that you all might have questions, so I want to kind of approach the end of this conversation, but what are the things that companies should prepare? And maybe, as a marketer, I'm saying go-to-market metrics, know your numbers, be able to defend your numbers. There's a technology perspective, and then, Claire, after, love to get your perspective on disorganization or not.
I would argue that it did not get easier to build companies.
It's not?
No.
Okay.
No.
And then this is a market.
I have a slide when I give presentations. I have a slide from a technical and product perspective. It's a lot harder because the expectations of the users are a lot higher. I think what makes it easier for founders is that this industry is now more mature than it was like 15. I started 20 years ago in this industry, so we had to figure everything still out. Today, lots of companies have been there before us, so there is a lot more knowledge about how to do this properly. So I think that makes it easier. Of course, there is lots of tools that help you run your business, but doing it right and doing it well, I think it's as hard as it was before. And there is so much competition, so that makes it also a lot harder to be the one that gets to good numbers, let's say.
That's where the marketers come in.
Yes, exactly.
It's harder for us.
But it's interesting what you mentioned there. I think as a good founder, and it's actually, if you talk about remote companies, it's one of the very important things as well. Documentation is essential. Any VC will ask you to provide documentation, the regular updates, quarterly updates, whatever, for board meetings. And even if you're a bootstrap company, like if you're just the three founders with no VCs involved, I think it makes sense, and we do that for us as well, to have this kind of documentation ready, just for yourself, so you know what your numbers are. But then, of course, if at one point in time someone is interested, you can just open your book.
That's right.
We had a couple of private equity firms being interested in us in the last year. And there we just like, okay, sign the NDA, and then you get access to the data room. I mean, we don't need a data room, right? Because we're not interested in being sold, but we have it for ourselves. All the legal documents are in there. All the financial documents are in there. It's also just for internal security. Like if I would die one day and my co-founders have to find all those documents, I mean, that would be a pity, of course. So it's just a good thing of what we call in Belgium good parenthood of your company. So making sure you have all these things documented and ready, and then of course you can just pull them out of the cabinet when you need them. I think that's the first thing to do.
Including the technology stack.
Yeah, for technology, I mean, there's a couple of things to say about that. I mean, if you're talking about being acquired, I think the most important thing is to try to understand like what kind of acquisition are we talking about? Are we talking about acquisition for the IP? Are we talking about an acquisition just to stay as a separate legal entity? Or are we talking about an integration, which is three different things? If you look at, for example, Microsoft, they're buying companies just to let them go out of business, more or less. I'm a friend of mine who sold to Microsoft, and then Microsoft promised them the product will stay around, and then like 1 year later they censored it. I think Google is doing the same. That's of course, then you don't care about like, I guess they didn't even do any technical due diligence looking at the source code because they knew from day one that was their plan. Of course, if you want to go for an integration, I think it's very important to, as a founder, even if you're not technical, to try to understand like how will the integration be, and from our team, who will be part of the integration. So being very open with your team that it's a possibility that there might be an exit at one point in time, even before you start the conversation, be vocal about your team. Like, okay, we might go for an acquisition at one point in time so that they can mentally prepare ready for it. As an engineer, it's a lot harder to cope with these kinds of things. And as, for example, a salesperson, I guess they'll adapt a lot quicker. Engineer needs a lot of time to think about that. And then start preparing for everything, I mean, in terms of documentation, security, compliance, but it's basically the things you should do anyway.
Exactly. Claire, quick commentary on that, and I'd love to open it for questions if you all have them.
Yes, of course, be prepared all the time. I just want to add, because exit is clearly driven by the CEO, clearly. Even when you own, after a few rounds, when the company doesn't develop as you expected, and even if in cases where the management team owns 5%, at the end of the day, this is you as founders, as team, who is discussing with the buyer and selling. So if at some point, and that happened to me several times, where for me, because of the life of our fund, it was time for us to exit, but the management clearly didn't want to sell the company. So that's where today there are those secondary sale, so funds that not only invest in the company, but also buys some existing, especially early stage investors. So you can really structure a lot of, depending on what's your idea about your company, where you want to, until when you want to go, then yes, sometimes it's a trade sale, and you're very clear when you discuss the acquisition. You say, I'm going to stay 1 year, 2 years, no more than that, because frankly speaking, I don't think this is the same state of mind to be in a startup that in this example than to work for Comcast. Very, 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 I mean, it's like working in another world. So as founder, you would not be as happy, maybe. I mean, there are exceptions everywhere. So there is one thing to sell to trade sell, but if you want to continue, and this belief that was listed, clearly the guy, and even with the acquisition of equity, he's still the CEO because he believes he can go further. Then there are some exit liquidity that can be negotiated. He cash some of it, but then puts back some of because he thinks that the development is not over.
Yeah, that's and that can go both ways, good ways and bad ways. True. So I'm going to open it up for questions. Anybody want to ask anything? Yes, red shirt.
Yeah. I mean, it starts like just walking around booths on conferences. So if there is industry conferences, the first thing you have to do is to just, walk up to your, You turn around your badge if you're more comfortable like that, and then you let them do their sales talk, and then you introduce yourself. Yeah, I think it's for that, for being acquired, but also for acquiring. I do that a lot for investors. Actually, I go to conferences to scout for startups. So I can do that easily because if you're an investor, go walk around, they'll kind of hunt you, right? For me, I'm a free person there. I can just walk up and try, and investor tells me, okay, we want to do a strategic acquisition or invest in a certain industry, and then we can. And so I think that's the first thing to do is to just if they're not around there, just ping them on LinkedIn. I mean, ask for a conversation. I think it's very important, even with investors. If you're not looking for investment today, to keep in check already with a couple of investors, keep them updated. Maybe they're not interested today, but maybe they're in a year. And by having that relationship and updating them like every 3 months or 6 months on your progress, they will tell you when they don't want you to do that anymore. But most investors, if they're actually interested in your business, but you're too small, for example, they're very happy to follow your progress. Yeah, for sure.
Where there's just not a lot of competitors in your space. My last full-time thing, we acquired our biggest competitor because it was internal comms. Like, this is like a tiny market, right? And there's just 2 of us, and we were the same parity,
exactly.
So it made sense after a time, and it made the company a lot bigger from a customer standpoint, certainly a lot more profitable.
But then in this situation, to be not too naive, I think the key question when it's a merger between equal is in terms of organization. There will not be 2 CEOs. So the key, when it happens to me, yes, sometimes it makes sense to merge 2 companies that are competing. I said, okay, first, let's look at their financial structure. How much money have they raised? And how much money have we raised? If one has raised 1 billion and the other one 100 million, the parity that you don't have to negotiate is impossible to negotiate. I mean, yes, exactly. Yes, so it's not gonna happen. Same thing, if the 2 founders have the same expectation, saying, I want to build a big company, so I make the acquisition and I want to be the CEO of the new organization, then it will not happen either. I mean, maybe I should put the other way around. I think finance, at the end of the day, you can always find a way. Organization, especially since you're founders, you're not executive in a big company. One day you said, I want to start my own company, so you have some energy that you're not going to be the number 3, number 4 in the new organization. So it's a key discussion to have, and it's not an easy one.
Sooner rather than later.
It's interesting sometimes to read the press releases when these kind of mergers happen. And if you read the press releases from either side, there's always clearly a side that marks it as a merger, and the other side who marks it as an acquisition. Yeah. And then you know who's the ones winning.
Yeah. Exactly. We had another question, Liam. Yeah.
Give me 1 second. So it's in the recording.
Yeah, Alban from SumUp. Just have from Aircall. Sorry, I just have a question because I was thinking about SumUp. Actually, my question is regarding that. SumUp has been Tiller has been acquired by SumUp, and I have a question because we have stayed within the new organization. What is the strategy to retain your people after an acquisition? Because obviously there are changes in terms of culture, etc. So how do you cope with that?
So when you make build-ups like that, yes, you buy market share, but you buy people, you buy a team, and so that's also the discussion when I speak about organization, who's going to be the boss, but also how do you retain with packages the different key people. So you identify the people that you absolutely want to keep because they are key for the integration, they're key. And so it's like incentives, just like what had been, if it's a private company, or bonus to be paid over time. There are also always earn-out as well that are being discussed. So it's clearly for the one who makes the acquisition to make the people feel like they are welcome and they want to stay. And so structure the package that will make them stay and not go to another company for higher salaries. On the funder, again, going back to the funder, in my experience, I don't have any example of a funding team staying after more than 2 or 3 years, let's say up to 3 years. Being bought by a large company and being, I don't know, head of sale in this big organization, head of product in this big organization. I haven't seen it. And I fully understand why, I mean, especially for funders.
Yeah, once an entrepreneur, you stay an entrepreneur, right? I think it's interesting as well that it also depends on the type of acquisition, of course. If it's an acquisition for market share, it might also be that there is deliberate choice from the acquirer to basically have the people leave, right? So that's yeah, that happen. If it's just for market share and not for then that's of course also I've seen that happening before. Yeah.
Yeah, final question.
Very quick, maybe perhaps for Claire, we have a very unique model, and I'd like to do in and out and exit in 3.5 years by just selling the IP. Are there any specifics?
No, that's we've done that, especially in deep tech. We have, and actually we have in our portfolio a company. We have invested 2 times in the same company because once it was only the IP that was sold to an industrial player, and but then the remaining company was then redeveloped and we reinvested in the, so the company is called Arteris in semiconductor. So 2 times. Some of our investors say, well, you're mentioning the success, but it was in another fund. I say, yes, but it's the same name for advice. But it's all about IP, how you protect your IP. Maybe it's more for you because the industrial player, they will they value, that's what they value. So maybe less the team, the market share, but what you bring. So in terms of preparation, pattern, legally speaking, licensing agreement with whom, all of that has to be very, very clear and very well defined. Change of ownership in your licensing agreement to make sure that if you're being bought by someone else, there is not an open to terminate the contract. Yes, legally speaking, you need to be well prepared.
30 seconds, so we have to wrap up.
I can say a lot about that. First of all, make sure if you work with subcontractors, make sure that all their IP is transferred. That's, from a legal perspective, extremely important. So if you have subcontractors working on your product and your contracts with them are not correctly done, then you're in big trouble if you're going to sell your IP. The second question is, if you're at a B2B SaaS conference and you have a B2B SaaS, I doubt that you'll be able to sell your IP because basically in SaaS, what is it? The time to market. So acquire is the buying time to market. So it depends on how fast they can rebuild what you have built. The IP itself is rarely worth anything. So if you come to me and you ask me, can you value my code base? If you tell me the team is not going with it, it's most of the time not worth anything unless it's like deep tech indeed. Yeah.
Good to know.
Sorry for that.
Sorry, bad news. And we're not going to add on bad news. We're going to say thank you. Thank you so much, both Andreas and Claire. Really good insights. You can get in touch with them through the app. And thank you all for attending today. And if there are further questions, we can probably just take them out here. So appreciate it.